A couple of people started out over the matter, so we're going to give them a couple minutes to find this place. Not easy to find. There's two up there.
How are you? Pretty calm. Not seeing you. Sandy. I'll never remember.
No, Sebastian, yes.
And is that again?
Jen?
Yeah, that's easy.
And your name? Bob.
Okay.
Go backwards and forwards.
Okay, yeah.
Sandy.
Right.
Have you been here before?
Never been to this facility before. But in full disclosure, I work for a company that's giving seminars. So.
Oh, you do?
But I'm on the tax accounting side.
I was on your website last night. One of the reasons that I am interested in this particular seminar is because I guess you just bought an account from or
Yeah.
right?
I heard that last January.
Oh, yeah, something like that. So, when you say accounting software, what type of accounting? Estate planning or what? I know they do payroll or,
Well, we.
the business accounting.
We do, financial statements.
Okay. So you're more on the business side. But how about the estate planning?
That would be more of these guys.
They were the,
They're the investment fund.
yeah, but I was talking about estate planning.
Well, a lot of the states have,
So.
Okay, we're going to get started on time here. We're at 6:30. We're still waiting for a couple of people, but we'll fit them in when they get here.
Oh, okay. More of that.
My name is Mike Ceci. I want to welcome you here tonight. I'm a fiduciary advisor with GWH Advisors and Accountants. We're located in downtown Newtown, right on State Street. We're financial services and a CPA accounting firm as well. We have about, 18 employees full-time on staff, and then we add additional people during tax season. Just a couple housekeeping notes. Each of you have an evaluation form in front of you. I need you to complete that and turn it in to Maureen before you leave. We need this for compliance reasons. We need to account for each person that's here, so we can write it off with as a tax event. Also, we like the format is interactive. So what I like to see is, please interrupt me anywhere along the way, ask questions. We're going to cover a lot of material, but we're going to cover it rather quickly. But if you have questions, please feel free to ask me along the way. If I can't answer it, I'll make up an answer. But we find out that we learn as much from the questions that are asked as we do from the prepared material. So, please, let's be as interactive and ask as many questions as possible. I need you all to read this disclosure. And at the end, we're gonna have a little quiz where we're gonna ask you the names of all those states that were allowed to do these workshops. That's also a compliance issue. So the title for tonight is Tax Efficient Retirement Planning. It's really, we're gonna deal with overcoming the major obstacles in having a successful retirement. A lot of people take the time to accumulate quite a bit of money over their accumulation years. They get to retirement time and then they have to put a distribution plan in. And at that time, if they wait to the end, sometimes there's just not enough time to put a quality tax efficient plan together. So what we try to do is encourage people as they come up on retirement or going into retirement or just retired, to really look at the obstacles ahead and try to anticipate strategies that they can implement early so that they can have a more tax efficient retirement. Therefore, their dollar will last as long as they do. Because one of the major fears that we hear from people from doing these workshops around is that it's the fear of outliving their money. And there's a lot of obstacles that need to be overcome so that money lasts as long as you do it. We'll deal with some of those this evening. As a second part of the workshop, we offer a complimentary consultation, which you see there. And a lot of financial workshops offer complimentary consultations, but I want to assure you or explain to you what is different with ours. How many have been to a financial workshop, other ones, where they had complimentary consultations? I don't know if you took advantage of those consultations, but I can assure you that ours is not about selling product or selling a program or a service. As talk a little bit about the complimentary consultation. Ours is built so that you can walk away with a completed plan. What we try to do during the complimentary consultation is break it down into two segments. The first segment, we're going to take an inventory of your assets. What you've accumulated, your IRAs, your 401ks, the non-qualified monies, and we're also going to talk about where you want to be 1 year from now, 5 years from now, 10 years from now, and where you want your money to go when you're done using it through retirement. And then we're going to try and find the best way to get you from point A to point B. And then at the second session, after we had a chance to analyze all that information, we're going to present a plan of the best route, most tax efficient way to get from point A to point B within what I like to call your sleep factor. And that's your ability to take on risk. So we want to be, because there are good investments, what may be a good investment for me may not be a good investment for you if you have trouble sleeping at night worrying about what the money's doing. So what we want to do is get you from point A to point B with a financial plan that'll fit into your risk tolerance, to your ability to accept risk. Once we've done that, we'll give you that plan. You'll walk out of our office. You can implement it yourself. You can implement it with the advisor you're currently working with, or if you want us to implement it, we can do that as well. But that's the extent of the complimentary consultation. The one thing we guarantee is we will not sell you a product, but we will give you a completed plan, and you can do what you want with it, including put it in the trash can right outside our office. And I think that's the most important part of this whole workshop, is being able to take a look at the obstacles and things that you can do to overcome them, but come to that complimentary consultation so you can walk away with your customized plan, so you know how to get from point A to point B. So let's get started. The one obstacle that we can't help you with Anybody know what that might be? Anybody? The one obstacle that we can't help you with, no matter, you have to do it on your own. Anybody have an idea what that might be?
When you're gonna die.
Well, I can't help you with that either. You can try and get close, and I'm gonna explain that to you a little bit. Anybody else have a guess?
Getting started.
Getting started, procrastination. Procrastination is the one obstacle that prevents people from being successful in retirement. People don't plan to fail, they just fail to plan. And I'm sure you've heard that many times. And the reason for that is they procrastinate. And we see it all the time. We talk to people about coming in for their complimentary consultation or even coming in for a review. And they say, well, you know, it's that time of year, got Thanksgiving coming up and the holidays and Christmas and Hanukkah. So call me after the first of the year. And before you after the first of the year and do the same thing. Wow, I'm getting my tax stuff together. My tax guy's really putting a lot of pressure on me. I'm waiting for all these forms to come in. Sure. So call me after April 15th, not a problem. We do, of course, it's summertime. Oh, I got Memorial Day, I got 4th of July, Labor Day, I'm spending with my grandkids going down the shore. Call me after Labor Day, call me in the fall. And we're right back to the same situation. We go completely around the calendar. We hear all the objections. Everybody knows there's never a convenient time. But to be successful in retirement, you need to deal with procrastination. You need to set the time aside and take a look at your financial situation. So tonight, we're going to talk about taxes, both income tax, short-term tax, long-term capital gains, and the death tax. We'll also deal with inflation. Although we can't control it, we need to understand it, and we need to know what the long-term effects are on the plan. We're going to talk about risk, which I mentioned to you before. It's important that you determine your sleep factor, you determine how much risk you want to take, and we want to make sure that your portfolio is constructed so that you can sleep at night not worrying about what your investments are doing. And then we'll talk about longevity, not outliving your retirement plan, making sure that your plan is secure enough to last as long as you do. And then when those assets pass to your beneficiaries, that they pass in the most tax efficient manner possible. And that's the key. And with that is understanding what the real rate of return is. And that is the rate of return minus your taxes is greater than the rate of inflation. And as you get through the distribution phase, then it becomes, the real return becomes the rate of return minus taxes, less distributions has to be greater than the rate of inflation. So you have real growth in your retirement portfolio. And the last thing that we'll talk about is healthcare. And the elephant in the room, which is preparing for long-term care, or the unexpected health threat that may come along, and how to best prepare for that. There's a lot of different ways, and they're getting more and more creative with how people are funding the cost of long-term care. So let's talk about taxes, everybody's favorite subject. We got income taxes, which is basically the tax you pay on your income in retirement or your Social Security or your pension. You also have dividend income, which is taxed as income. You also have taxes on capital gains. You have short-term capital gains. This is from the sale of assets that have a gain that's less than a year old. That's also taxed as current income. Or you can have long-term gains, which could be gains that you have from investments that you held for more than a year. Oops. We'll also talk about the hidden taxes, the ones that people don't anticipate, such as the Medicare tax, or people know it as IRMA. And if you ever experienced it, it's not a pretty situation if you weren't planning for it. Also, you have the widow tax, and then, of course, the estate or death tax. Believe it or not, you have to pay a tax to die, especially in Pennsylvania.
Am I good?
Yes.
with the outcome of this week's election,
Yes.
what's your outlook in terms of the tax trend for?
That's a good question. We just did a whole podcast, and if you go to our website and click on the little button at the top, we have a whole podcast of what we think the outcome of the elections will do. And I'll just give you a quick synopsis. I don't want to digress too much.
On your website?
Yes, we found out that regardless of what party is in control, it has very little long-term impact on the performance of the stock market. The things that we do look at, though, is the current tax law was due to expire in 2025. We believe they're going to try and make that permanent. And that's a good thing, especially for the middle class, because that'll keep our tax brackets where they are right now. And for us, that makes our planning a little bit easier, once we have clarity. It's always, the stock market's only concerned about uncertainty. Uncertainty has a bigger impact on the stock market than clarity. So even though if you know what the rules are, then you can plan for it. It's that uncertainty that makes the market as volatile as it is. So we think if they make the current tax law permanent instead of letting it expire at the end of 2025, that's something that we can plan for, and that's good for everyone. So let's talk about Medicare tax. IRMA is what it's called, the nickname. And what I want to do is draw an example of how you need to plan for Medicare taxes for each individual situation. Here, I have a couple, Mr. and Mrs. Claus. They are married filing jointly. They have taxable income of about $201,000, and that comes from pensions, Social Security, and investment income. That puts them in a 22% tax bracket under the current law. And their Medicare premiums are $174.70 a month times 2, or about $349.40. So they're paying about $4,192.80 annually. Well, they came in for a consultation because the advisor they were working with wanted them to convert $10,000 of their IRA per year. He set up a strategy to convert $10,000 of their IRA to a Roth before they turned age 73. So they wanted some tax information or a projections of what that would do to their tax return. And this is what we found out. That they're married filing jointly, they had taxable income now of $211,000. That's the 201 plus the 10 that they'll assume for the Roth conversion. Their tax bracket goes from 22 to 24%. The last piece will be taxed at 24%. Not that big a deal. But what happens to the Medicare premiums? The Medicare premiums jump from $174.70 to $257.50, or $515 a month. That's a cost of $6,180 annually. So the total cost of that conversion, I don't know if we can bring that up.
Yeah.
Now. It's okay. What you see is that just for a $10,000 Roth conversion in the wrong tax bracket drives up the Medicare.
So why is the payments much higher?
Why is it much higher? Because Medicare has a tax that kicks in at a certain level of income. And if you're only $1 over, then you have to go to the next bracket and your Medicare jumps up. And each time you hit another bracket, your Medicare gets more and more expensive. So that when you do, the point of the illustration is to say, you need to be aware of the Medicare tax when you're over 65. And anything you do to increase your income, you better be careful it doesn't increase your Medicare tax. And we have to look at that in every scenario, especially when we're doing Roth conversions after age 65. When you come in for that complimentary consultation, we got a few handouts that we'll pass on to you. One is the Baby Boomer's Guide to Medicare Planning, which will explain all that in here. Also, Social Security. But the more important thing is we have these key financial data which shows you on the back Medicare and where it kicks in. $1 over and how your premiums go up, not only on the Medicare, but also on the prescription.
So that's 2 years after that they charge you the extra premium.
Correct.
Now, if that was a one-time event, if you go back to them and say, I want to leave, that's never going to happen again.
We've had the CPAs do a number of letters and ask for an appeal, and we've been successful with that. So, if you do happen to get there after the fact, then we may be able to remedy that as well. Now, another tax fee,
They look back 2 years, correct?
to go back to,
So, just say if my retirement age is 67. Okay. So when can I stop doing Roth conversions and not have that penalty? It would be 65?
are you still working at 65?
Yes.
Because if you're still working at 65 and you're on your employer health insurance plan,
Yes.
then you don't have to worry about Medicare.
But if I retire at 67 and I've been doing Roth conversions, like since the age of 60, I would have to stop 2 years prior.
Yeah, that would probably be a better strategy, or, yeah, I guess, that's a good question, I'm not sure I can answer that, how they would look at that, because that's really going backwards. So, and I can find that answer out for you. The widow tax, I like to refer to, I don't know when I'll call it the widower tax, but I guess women just outlived the men. But it's basically the surviving spouse tax. This is something you have to be very, very, very careful of. So Mr. and Mrs. Claus, as we talked about, is married, filing jointly. They have gross income of $230,200, and they have a standard deduction that they take at $29,200. So they end up with that $201,000 taxable income that I showed you on the previous slide. That's how we got to the 201. Puts them in a 22% tax bracket, and their Medicare premiums are $349 a month. Now, unfortunately, Mr. Claus passed away last year, so we're now a year later, and Mrs. Claus is single and filing as a single. Has gross income of $212, and the reason why it went down is because you only get one Social Security instead of two. So she lost $18,000 of income, so her gross income actually went down. Her standard deduction now is $14,600 because she's single. So her taxable income is also lower, $197,600. But what happens to her tax bracket? She's now in the 32% tax bracket with that income as a single. And that's a substantial more tax that she has to pay. And her Medicare premiums, because of that income as a single, now become $633.20 a month, just for her Medicare premiums. So that's the widow tax. That's the surviving spouse's tax that you have to be concerned about. And we usually get involved after the fact. We like to do the planning in advance. So we think that the complimentary consultation, this is something that we will deal with as well. Because it's an individual situation, one-on-one, but it's something you need to be aware of. It's another hidden tax in retirement that you need to prepare for. Am I depressing you yet? I'm trying not to. Just trying to make you aware of things that we see every day, usually after the fact. Because people come in and talk to the accountant and say, I don't understand why I got this Medicare bill. So you got the Medicare bill because this, and this. So let's talk about some tax strategies that you can do in advance to help offset some of this stuff. Things that we do on a regular basis. Tax loss harvesting. I'm sure no matter what age you are, if you have an investment contract, you're doing this in the fourth quarter of every year. We do it every October. What it does is we look at what your winners are for the year, what your losers are for the year. If we're going to do a reallocation, we want to sell off some losers. We're going to sell off some winners and take the gains and and use that to offset it so that we have revenue neutral. So you don't have a taxable event. And then we reallocate those dollars back into a new model going forward for the next year. So tax loss harvesting is very important, not to do once in a while, but to do it, you need to look at it every year, near the end of the year before you file your income. Second thing is a Roth conversion strategy. The earlier you start a Roth conversion strategy, it may be to your benefit. But more importantly, if you can do it before age 65, it makes our job a lot easier because we don't have to deal with the IRMA tax on Roth conversion. Also, there are tax deferred accounts. So if you have a non-IRA or regular investment account, and you're growing it and you're using it every year, but you're not taking any income from it, it's just there to pass on to the next generation, then why are you paying tax on the dividends and capital gains? So there's a way that you can defer those taxes, so let your people who inherit your money, let them pay the tax rather than you pay the tax. Another strategy is managing your tax brackets, and we talked a little bit about that in one of the examples, and that is if you're going to do Roth conversions, not only looking at IRMA, but if you're not under 65, what you want to do is look at where your tax bracket is. It only convert up to a certain tax bracket, not above it, so that you're not paying more tax than you need to. So it's important that you find out, what your actual tax bracket is and how much room you have in that tax bracket, and that allows you to do a lot of different strategies. If you are charitable, if you're a charitable giver and you're contributing to charities on a regular basis, or you plan to make a large charitable donation after you're gone, or while you're alive, you want to make contributions, and you're in the R&D phase, if you're over 73, then you should take advantage of the qualified charitable deduction.
Excuse me, that's 70 and a half, you start taking it.
70 and a half. I'm just saying, if you're taking RMDs and you're at 73. But at 70 and a half, you can start. You can donate up to $100,000 to the charity from your RMD and not have to pay tax on the distribution. Especially if you're paying tax on RMDs and not utilizing the money. If you're just paying the tax and reinvesting. So if you are charitable minded, that's enough. Also, before age 65, we like to encourage everybody to maximize their health savings accounts. If you can qualify for a health savings account, then you should really fund that to help, because if you don't use it, you don't lose it. And when you pass into retirement, it gives you a lot more flexibility for spending and using tax-free dollars. So you get a tax deduction for it before 65, and you can use it tax-free, almost like a Roth, after 65 if you follow certain regulations.
Earlier you mentioned the tax deferred accounts. Can you say that, let's say I have $1 million sitting in a regular investment account, and I'm not taking any money out, I don't need the money, and you say that, that we will get my money without the possibility to pay the tax. Are you suggesting give away the money while I'm still alive, the keep tax portion, or?
Now, what we're saying there is if you have a non-IRA or a taxable account
Yeah, I don't need the
that's
money.
earning dividends and capital gains,
Yeah.
and you're paying tax on those dividends and capital gains every year, but you're not using the account. You're not taking income from it. It's just going to accumulate, and eventually you're going to pass it. You can leave those taxes in there by taking that investment and making it tax deferred. And there's a lot of different ways to do that. And therefore, the dividends and capital gains are not taxed when they're received. They just stay in there and build up more. And then when it passes on to your beneficiary, they deal with the tax.
Can you give me an example? I still don't get it.
You don't get it?
No, I mean, I know what you're saying, but in terms of different ways of doing it, not my children or grandchildren to pay the tax.
Right.
We paying the tax. Give me one, like what? Confined annuity or you health insurance policy?
Annuity is one, yeah, I hate to use the word annuity because there's all kinds of annuities. There's good ones and bad ones. We're talking about annuities that have no expenses in them, that are 100% liquid. You don't have a surrender charge. You can use it just as a wrapper around your investment account. and you can get to your money anytime, but as long as you leave it in there, you don't pay the tax. So we go, more question on the tax side?
Question about the HSA,
HSA.
right, because my understanding right now is that you don't take HSS right now, before you age 55 to 60, right? Whatever money you're not using it, you're going to lose it, right?
Correct.
So how this will be different, say like in the retirement, when you,
Well, after 65, and you go on Medicare, you're no longer allowed to contribute to an HSA. So it becomes fully funded, and at that point, if you didn't use it for medical expenses to cover your deductibles, and you have a Medicare plan that's paying for everything else, you can use it for other things and still be able to not be taxed on it. Different strategies to use that, including paying your Medicare premiums. So you can pay your Medicare premiums with tax advantage dollars, your HSA you can use to pay Medicare.
Are there different HSAs then? Because like mine is a corporate company, mine, you have to use the funds by the following like March.
That's an FSA, that's a flexible spending account. Different from an HSA, which is a health savings account. That's a good question, because a lot of times people confuse the two, and they overfund their FSA, and then they lose it at the end of the year. Yeah, so HSA, the money carries forward. FSA, you gotta spend it or lose it by December 31st.
Yeah.
So we're gonna talk about inflation and mitigating the effects of inflation. What are some of the things you can do? We can't control inflation. It's gonna be, whatever it is, it's gonna be. But we need to put together strategies that's gonna help us deal with it so that retirement income doesn't get eroded by inflation. Some of the things you can do are inflation protected securities. The best ones are issued by the government, they're treasuries, they're called TIPS. Like diversifying within your stock portfolio, sticking to dividend paying and growth stocks will always outpace the rate of inflation, at least they have through history. Real estate investments, that's direct real estate investments, if you have investment properties and you're collecting rents, that's usually a good hedge against inflation and usually outpaces the rate of inflation. But if you don't want to be a manager of real estate, then there's real estate investment trusts or REITs. And again, there's good ones and there are bad ones, but the good ones will help you outpace the rate of inflation and still keep your money liquid. But the key is to maintain a balanced portfolio. It's not any one of these things. It's really an asset allocation model that includes a little bit of all of those things, which will help your whole portfolio outpace the rate of inflation. So the last thing I always like to make is people should also consider adding to that now alternative investments. These are investments that are not correlated to the stock or bond market. They just operate on their own. Things like private equity, infrastructure, hedge funds. There's nothing wrong with having good ones as a small portion of your overall portfolio, because that'll help you outpace the rate of inflation. And we know what inflation is because you go to the supermarket and buy groceries, you feel the effects of it every day. Hopefully it'll start to come down. Any questions about any of this? I'm speeding through it. I'm going to show you some more examples after we start eating. Right? When you sit down, I'm going to sit down and show you some really good case studies. I just don't want to bore you. I should be done here in another 2 hours.
Do you consider alternative investments like EFTs, or is that more in the stock area?
Yeah, EFTs, there are EFTs that invest in infrastructure, private equity, hedge funds. And that's one way to invest in those in with a low fee. EFTs are much lower fees than mutual funds. Yeah, I'm not saying you have to invest directly in them. You can invest in them through EFTs. So risk and volatility. Each person, what we try to do is evaluate, well, I give you a little questionnaire and you find out what your risk score is. You answer 5 or 6 questions and it gives you a score. And that score is anywhere from 0 to 100. And the higher the score, the more risk you're willing to take. The lower the score, the more conservative you are. So what we need to do is try to find out what your risk score is or what your sleep factor is. And then we take a look at your portfolio. When you bring in your portfolio to us to evaluate, we also put that into a model that we have, and that gives us a score of your individual portfolio. And the funny thing is, I have people come in and say, boy, I'm really a conservative investor. And then we put their portfolio through the thing, and it comes back with an 85. So their personal score is 45, their portfolio is 85, but they think they have a conservative portfolio, and they don't. Or vice versa. So it's finding out your risk of volatility, or finding out your sleep factor, knowing what your portfolio rates out at, and then making sure that you get them in line. That's part of the overall plan, reducing the amount of that risk. How do you do it? We have through diversifying your portfolio, as we spoke before, that helps to bring down the risk, adjusting your asset allocation model, adding low volatility or defensive stocks to your portfolio, things like utilities, infrastructure, and then developing a comprehensive bucket strategy. One of the things that we suggest that people do when we take a look at their portfolios is they split their money up into 3 buckets: short-term, mid-term, long-term. And you can be more aggressive with the long-term, less aggressive with the ones you're going to use for income. People often say, I'm really happy with the rate of return. I got a great return last year. The return is here. And it is good. But when we put their portfolio in the thing, we see that the risk level is up here. Well, if you're happy with your rate of return, then this is what you need to do to reduce your risk. You can keep your return here, you just don't need to have as much volatility. But if you're happy with the amount of risk you're taking, then you need to be making up here. Your rate of return needs to be up here. So your rate of return for the amount of risk you're taking is here. If you're happy with this return, then you need to bring your risk down. And that's what the whole thing about risk-return ratios are. And knowing that your portfolio is in line with what you're trying to accomplish. So develop a comprehensive bucket strategy, and of course, maintain an emergency fund for distributions. And why do we do that? Because what we try to do is make sure that you have in that first bucket anywhere from 6 months to 1 year's worth of monthly distributions. So if you're in a distribution phase and you're taking income from your portfolio, we don't want to have you sell investments during the year to create liquidity, especially if the market is down. So we want to have enough in that first bucket to cover all your monthly expenses for an entire year, 6 months or an entire year. And if the market runs up, then we'll create more liquidity to replace that as we go along. But it's a strategy to make sure that you maintain that emergency fund, but you also manage your portfolio for the long haul. Which brings the next obstacle, which is longevity. This came up before. We don't know how long you're going to last in retirement. So what we do is we plan for the longest we can. Now, I'm going to tell you a crazy story. I spoke to a gentleman this week, because I want to have him as a guest on one of our podcasts, about AI in the medical profession and what affects that, what they're doing to utilize artificial intelligence. And what I found out was kind of exciting, but kind of made me a little nervous. And that they have a program. He told me about a startup company that they invested in that takes your medical history, and they put your medical history into the AI, and they look at your, some of your family history or whatever. It all goes into this gigantic computer, and this computer can now predict with accuracy of an accident, the year in which they think you're going to pass away. He said he thinks by the end of this year or the beginning of next year, second quarter, they're going to be able to refine that down to the month. I don't think I want to know that. I don't think my clients want to know that either. Barring some kind of accident, but that AI in the medical profession is really they're using it for diagnosis. Rather than have a doctor ask you a lot of questions, they take all your medications, they take all your vitals, they have all your signs, they put it in this giant computer. It's reached a point now where if you're having something going on and you dial into this computer, you can dial in and they'll tell you, you give them your symptoms that you're feeling, and they'll tell you either to dial 911, they'll tell you to go to urgent care, or just relax and go to the store and buy this medication, but they'll give you advice, spits out information as to what they think is going on and give you immediate feedback. But let's talk about longevity for retirement. Enough about AI. But you need to estimate your longevity accurately. We like to say, let's start at 95 and either work up or down from there. But we want to make sure that your retirement income is going to last at least that. And then depending on your current health situation, your family history, whatever, you want to look at Social Security options, making sure that you choose the right Social Security option, whether you delay it, take it early, take it at full retirement age. But it's important to know that there's a lot of different strategies for taking Social Security, and you want to make sure you're selecting the right one. You want to maintain growth in your portfolio. So many times people reach retirement age and they think they need to put everything in bonds and safety. And it certainly needs to be a larger portion of your portfolio. But you also need to keep a growth element in there. You need that growth element to outpace inflation, so that your portfolio outpaces inflation, so that as prices go up and you need more and more income, your portfolio can provide that without running out of money. And create a sustainable withdrawal strategy. Sustainable withdrawal, it could be 4%, it could be 5%. But if you need a withdrawal strategy of 8, 9%, it makes our work a lot difficult, because that's a tough percentage to sustain. And then you have to plan for inflation, healthcare costs, volatility in the market. But the main thing is you need to keep your portfolio flexible. You have to stay flexible enough so that you can change as things change. As inflation goes up, as inflation goes down, as your need for money goes up or goes down. So you don't want to necessarily set up a plan and not revisit it at least once a year and make minor changes to it as well. Which leads us to the last obstacle, which is healthcare. Healthcare is really preparing for the unexpected. When you choose your Medicare, we have that little booklet in here, you want to make the right choice for your situation. And even when you make that choice, you got to remember that every October you have a chance to change that. If you feel that you made the wrong decision, you can fix it by changing that option anytime between October and December 7th. You have to plan for out-of-pocket costs, especially in the drug area, in the RX area, because the cost of prescription drugs is rising faster than the rate of inflation. We often encourage people to create a retirement healthcare fund, just a fund where they can fund it, keep it liquid, keep it short, but get a good rate of return, and use it to pay those unexpected health insurance costs that may come along. And then develop a strategy for long-term care. It used to be, you would buy a long-term care policy in your 50s and 60s, and it was relatively reasonable. But you find out as the years goes on, the premiums are not guaranteed, and they increase, and they increase, and they lower your benefits, increase the premiums, to the point where you can no longer afford to keep that policy in force. Now they have other alternatives. They actually have, where you can, if you have a portfolio, you can set aside 25 or 50,000 into an investment account that earns interest. And if you go into a nursing home where you need home health care at your house, they'll give you up to 5 times that amount in long-term care coverage. And if you never use it, you don't lose it. It passes on to your beneficiary when you die. Or if you use half of it and then die, the half still passes on to you. So you have other alternatives other than just buying a long-term care policy. But our real advice is stay healthy, stay as healthy as you can, eat a healthy diet, and reduce your future healthcare costs. That's probably the number one thing. So where do we go from here? I want to thank you all for coming. We covered some of the obstacles. I know I covered a lot of material in a short period of time. But the reason why we set up the complimentary consultation is two reasons. One, there's probably a lot of questions on your mind that you'd like to ask, but you don't want to ask it in a large forum like this. So bring your questions to the consultation. We'll be able to answer as many of them as we can. If we can't, we have CPAs there. If it's a tax question that's out of our realm. Also, we'll help you take a look at your snapshot of where you are, talk about where you want to be, find the best way to get it to you, wrap it up, give it to you, walk out and implement that however way you want. But don't procrastinate, take advantage of it. I'm hoping to see each and every one of you at the planning meeting. But I think they're going to be serving food soon. Thank you.
Thank you.
I usually get a standing ovation, but I understand these chairs are not there.
Mike, can I forget, you guys do trust?
We do, we work with the attorneys. Are they bringing up?
I just hope.
Michael? Yes. What's your specialty in terms of